Right. Well, welcome to everyone who's joined. I think we're all here for obviously very similar reasons. Lots of people have we're I think it's definitely resonated. This topic resonates with a lot of families out there. We've got literally generations of memories that have been built, and we're seeing a lot of noise out there these days with things like capital gains and all that. But I think ultimately the goal of this presentation is really to really open your eyes to some options that you may have to keeping that cottage legacy intact. And so we're really, looking forward to sharing some of the ideas that Dan and I have, but also we're excited to have the guests we have on as well. We've got with us uh, Jim Whitty. He is a CPACA. He's a tax partner at Miller Bernstein LLP. And we've also got Emma Michael. She's a BA JD partner at Ion Law Partner. She's a partner there. And she's got some really good options as to what we can look at in terms of when trying to create a legacy for cottages. Um, and so the agenda might shift a little bit. I know I've got Jim kind of coming in from from the client call, so he's going to text me when he's on his way here, and we'll so I got to keep my eyes out for this. But basically, we're going to do a quick introduction to everybody here, the speakers and the guests. A little bit about our cottage stories. Dan and I have a couple cottage stories. Jim will have one as well. Um, Talk about some of the goals that we're trying to achieve in what we're building here. Focus on some of the problems. I mean, we're definitely seeing capital gains as a big piece, but there's other issues that we have to address in order to maintain the family cottage. And then we're going to go through some solutions. Emma's got about, I think, at least 5 examples she's going to walk through, but really talk about kind of what kind of structures to put in place, what kind of plans to put in place in order to make sure that we can maintain this going forward. Myself and Dan are going to walk through, the financing options, what are ways to do it, because inevitably, no matter what we build here, even we're building a trust or whatever may happen, taxes are inevitable. We're all good tax-paying citizens in Canada. And inevitably CRA is going to come at some point. So we're just trying to find which ways that we can help alleviate some of those issues. And then finally, we're going to wrap up and we'll find out a little bit more about how you can connect with us. Dan, I'm going to pass it over to you.
Ah, here's an amazing slide. What is special about the cottage? Some beautiful, fantastic pictures up here, and Peter and I discussing sort of really what the pillars are to cottages, and we really came up with these four: family, friends, water, and nature. And I think that resonates probably with a lot of people on here. So when it comes to family, you can see here, this is my family sitting at a campfire, but quality time together. We were just up. We try and make it up most weekends now, and that really the quality time that we can spend, whether it's around the campfire or whether it's morning coffee, watching the kids playing or whatnot. It's incredible watching the kids growing up at the cottage and learning new skills. So just, whether that's canoeing or kayaking or fishing, it's just the new skills that the cottage can present are so valuable. The next picture is friends. So breaking bread together, those meals together, the reconnecting with people and making new memories. So whether that's just sitting on the dock having a coffee and reminiscing or laughing and crying, all of the above. Of course, cottages go hand in hand with water and lakes and some people oceans, I guess. But the peacefulness that water brings, the sound of the water, those sunrises and those sunsets are certainly special times, unforgettable times. And then finally, nature. There's something about it just feeling right. There's something about those loons calling early morning or late at night, and simply putting those cell phones and those iPads and disconnecting from technology, maybe from the hustle and bustle, and just taking a breath and slowing down. I'm gonna flip over there, Pete, to the next one. All right. So we're really trying to make this as interactive as possible this session. So we want to involve everyone on here. So if we could populate the chat on what do you love about the cottage? What is it the morning coffee on the dock? Is it the glass of wine in the evening? Is it fishing? Is it, is it gardening at the cottage? So just quickly, let's populate that. Let's enjoy watching and seeing what other people have. Family, gardening, escaping, quiet spaces. I can definitely resonate with that. Clear water, kayaking, grandkids, absolutely family. No motorboat lake, just peaceful kayaks, canoes. Yeah, so these are all memories, family connections. History, Brenda, absolutely. I can resonate with that. Dave, all the above. It's like a multiple choice question, A, B, C, D, or all of the above piece. Yeah, so good, everybody. That's great. Well, keep them coming. We're going to, uh-oh, skinny dipping. I had a feeling Pete and I thought someone might say that in the chat. So amazing. I love the sense of humor. It's awesome. 45 years and counting up there. 65 years. Yeah, the history is a big one. And the reason that we're all here tonight, and we're here to share the knowledge and how we can preserve that history. So awesome. All right, Pete, let's fire over 68 years, 69 years. Wow, 5 generations. So good. Oh, thank you, everyone. All right. So our values at Return on Life, our mission simple. It's to keep the family cottage in the family. That's what we want to do, and that's what we're focused on. Our mission is to ensure that each generation of the family has the same opportunity to experience the cottage living. So family, friends, water, nature. I want my kids to experience what I've experienced, and I'm doing everything in my power in order to do that. I'm pretty sure they're going to do the exact same because it's such a special place. And that's why we're doing what we're doing. The vision, every family and circumstance is going to be unique and different. We pride ourselves on listening to our clients and finding solutions that meet their long-term goal. Yeah, there's so much uniqueness when you're talking about family and you're talking about real estate and you're talking about history. There's going to be circumstances. We've worked with clients who are cross-border in the US. So we're working with different people with different circumstances, and we pride ourselves on listening and helping for sure. And we want to be sort of seen as your guides through building a rock solid legacy foundation. So we're there to help support, guide you, find the right experts for you. We can be the experts in certain situations, but we're building out that team. And our building blocks include one is family discussion, two is building out the proper estate planning cottage agreements, and then three, making sure that we are funding this legacy and the money is streamlined and is there for generations to come. All right, jump over there, Pete. All right, I have the pleasure and honor of introducing Peter Lown. So Peter's married with 2 children, son 12, daughter 14. They're a big hockey family. Every time I seem to be calling, Peter is traveling around somewhere in Ontario. He coaches both kids. They love traveling in the off season, hiking. He's a foodie, so he's definitely enjoys restaurants and trying new places. Really focus on help families preserve memories and secure their legacies while supporting growth and smooth transition into retirement, ensuring long-lasting legacies for generations to come.
Right. Thanks, Dan. And so Dan, he's married himself with he has 3 children. He has sons Hudson 11 and Riley 8 and daughter Everly 4. His family really values the outdoor adventures, especially at his cottage on lake.
Kashigawigama, Peter.
I can practice how
Kashigawigama.
many times I still didn't get it, but
Yeah.
in Halliburton, hiking, fishing. He's a big fisherman. all things sports related, uh, keep Dan and his family very busy. He knows the value of family moments and is committed to building out solutions to ensure cottages are kept in the family for generations to come, much like his own. Now our expert. So Emma Michael, she's on with us. I think Jim's coming on in a couple minutes here, but I can still introduce them both. Emma is one of the founding partners of Iron Law Partners. She's deeply committed to empowering her clients by setting highest standards, as well as providing them with personal and comprehensive legal services. She's got a lot of experience in real estate, a lot of experience in estate planning, creating legacies for families. She's going to go through some various options that you may or may not have seen today. And we're going to go through a couple examples in the Q&A that she's going to help to be able to elaborate on as well. And we're super excited to have her on today. So Emma, thanks for making time to come on and share. Um, and then we've also got Jim Whitty. Jim is a tax partner at Miller Bernstein, and he's got a wealth of experience in the tax world. He's a CPA, CA by trade. He's worked in private sector, worked at CI Investments for a number of years on the tax retirement estate planning. He knows a lot about cross-border type tax issues as well. So personal and corporate planning, estate planning, kind of a whole mix of it. But himself and his firm do cover a number of different areas. So I'm pleased that Jim is able to make it, and look forward to him sharing a little bit about breaking down some of these things that I think sometimes inevitably it comes to things like taxes and in the news. This has created a big maybe emotional jolt for a number of cottagers out there. But I think part of this process, we're coming in and we're bringing the experts, is to bring knowledge and bring some information so that we can make uh, inevitable decisions that we have to make. And that's why we have the experts on. So we're happy to have them both. Over to our cottage stories. Maybe I'll start with mine first, Dan, since mine's pretty short. Uh, so my mom's mom, my grandmother, she in the early 70s literally took a course on, I think it was general contracting or something like that. She ended up getting a cottage built on a lake road just across the street from Georgian Bay. So I remember as a kid being able to go down to the pebbly beaches on Georgian Bay, but then also spending some winters learning how to ski up in Blue Mountain as well. And yeah, it's like and when she passed in 1988, my mom had 6 other siblings. So between the 7 of them, they just decided to sell. And the ironic part about this is I'm sitting here, Dan and I were talking about this whole thing that we're coming to bring to fruition to people. Is I just feel like our family's been chasing cottages every year since. So I completely understand, what people have built and what they're trying to build going forward, because can be so powerful. Dan, over to you.
Yeah, thanks, Peter. There's a long line of McMullins. My great grandfather and mother purchased in the early 1900s 5,000 feet of frontage on Lake Cashawigmog. At the time, it was a farm, and there was a farmhouse, and they had children. And what more from that farmhouse was 4 cottages similar to what you're seeing on the screen right here. So that's my cottage. It was built in 1934 by my grandfather, and very little has been done since. And by design, we really want the true cottage experience. You can see those windows open up, and they're beautiful. And my kids are experiencing getting their water from the lake, and just the true ethnic experience from a cottage. So my children are 5th generation cottagers. So it's so important that I preserve this legacy for them. So very good. All right, interactive time. Oh, did we do this one with Peter already? The cottage activity?
Oh, maybe we did.
Maybe that. Okay, so this is a little bit different. The other one was, what was your favorite? Well, they're very, very similar.
What'd you like
So,
best about the cottage, right? This is
yep.
more activity. Um,
Activity based. So do we have any water skiers? Do we have any fishermen? Do we have any, oh boy, hikers? Do we have any wakeboarders? Let's see what populates the chat. Swimmers, that could be another one. Golfers, how do I forget that? So, yes, thank you, Joy. There's something about exercise is another one. I think one of my favorite things is to go for a morning run. And then right after the run, you jump right into the lake. Wakeboarding, canoeing, there we go. Water skiing, pickleball. I know that Kinesis Lake has a pickleball court right at their marina. They have 4 beautiful pickleball courts. I'm very, very jealous. I know water sports, etc. Watching kids and grandkids enjoy it. Yeah, the water, such a big draw. Paddleboarding, my wife's a huge fan of that. Actually, the pictures that I have are actually of my wife Allison on a paddleboard, fishing, swimming, boating, hiking. Yeah, so good, Mary. Fantastic. Fantastic. All right. Goals and objectives. All right. So we're really setting everyone up tonight. We're really trying to get a flavor of the cottage experience. But our goals and objectives are this tonight. Is protect the family cottage. That's number one. How we're going to do that? We're going to build out a multi-generate. We're going to show you how to build out a multi-generational plan that's secure. The foundation is solid, and it is built right. And then number three, very, very important. At the towards the back half of the webinar, Peter and I are going to talk about financing a cottage legacy, because there is a multi-tool in the toolbox that we want to share with you that we believe is going to be able to streamline your finances to really secure the cottage for generations to come. All right. What are the problems? All right. So really what we're going to preface here is there are problems that could arise with the family cottage. So there's no bones about it. Families are complicated at times. All right. Family dynamics. A lot of cottages are shared. A lot of cottages, the families grow, and family dynamics comes into play. And really we need to navigate family dynamics. So that certainly is something that we need to talk about. Maintenance and upkeep. Cottages are expensive, boats are expensive, roofs are expensive, docks are expensive. That is a problem. Property taxes are not going down, unfortunately. Every time you see new construction or there is going to be an increase in property taxes. I know if you've owned the cottage for 20, 30, 40, 50 years, we all have stories about how our property taxes have changed. Cottage mortgages, that's definitely a problem, and we're going to speak that in a sec. The banks play by different rules when it comes to cottages. And then estate taxes and capital gain is certainly a problem that we're going to be addressing. Peter, over to you for family dynamics.
Yeah, so this is where we get into the family dynamics piece, just expanding upon a little bit what Dan had kind of alluded to before is really at the end of the day, um, like over time things change for people too, right? So at the end of the day, who wants the cottage, who's willing to maintain it, who's going to spend the time there to help out? Do you have enough time to use the cottage? Not everybody's doing the same things. I mean, if it was just hockey season alone, I cannot touch a cottage. It's so busy at that time of year for us. So obviously the winter would be a write-off for us. But I know a lot of folks here. We didn't even ask that. Another good question is like, how many seasons do you use your cottage? Because that's a whole nother piece to it. Splitting out usage equally amongst family members, that can be tough and can be it sounds easy, but can be sometimes tough conversations that happen based on kind of um, how that's happening. And then the last part is really just literally the dynamics. Does everyone get along? As families grow and change over time, those dynamics can certainly change. And so that's definitely impactful on the cottage experience.
Yep. So really quick, we discussed this maintenance costs. Things are very, very expensive. We have cottage mortgages. If you need to, for ever circumstances arise with families, let's say you own a cottage with your sister or brother and they want to go and buy their own cottage and a mortgage needs to be put in place. Well, the banks might say it needs to have filtered water, or it needs to, it needs to be a 4-season cottage and not a 3-season cottage. So the rules are much, much different when it comes to mortgaging a cottage as opposed to, say, a place in Toronto or a major city. So gonna flip over, Pete. Next one. Cottage cost reality. So the reality is, you can see here a $1.2 million cottage bought for $250,000 in 1998. We're talking about a million, almost $1 million gain, and we're going to incur capital gains down the road. These are big, big numbers that we're talking about. And then, of course, property taxes. Like on a $500,000 cottage, you're looking at $4,000+ for taxes and insurance, and that's just a $500,000 cottage. Many of these cottages within an hour or 2 hours of the GTA are approaching $1 million, and if not north of that. So, um,
Yeah, we
great,
didn't
Peter.
even, I mean, one of the things we kind of allude to too, we didn't cover off, was even utilities. If you're on the grid or off the grid, makes a big difference. Those pieces can be certainly quite extensive as well.
Yeah.
Now we're going to get into capital gains. We welcome to Jim. Really pleased to have him on today again to really break down the proposed capital gains tax. I guess it's not fully implemented yet, but it's something that is potentially coming. I mean, one thing, Jim, you probably answer this or not, not if you want to, but are taxes going to be, do you ever see a day where taxes are going to go down? I think inevitably it's just something that we're all going to have to eat at some point, but it's about building the right, quantifying it, understanding it, and then putting the right plans in place to be able to take this on. And maybe Jim, before you get started into it, the capital gains piece, can you maybe tell us a little bit about your cottage experience as well? You had a family cottage at some point as well, right?
Yeah, yeah, for sure. And thanks everybody for having me tonight. Sorry, I was a little late. My family did used to have a cottage. My grandparents and my dad owned it together. It was up near Thornbury, just outside of Thornbury. So we used to ski a lot. We used it mostly in the winter. We'd go in the summer as well, but like skied every weekend and March break, Christmas break, all that. My grandparents passed away around the year 2000, and my dad just decided that he wanted to sell it, and I was just sort of getting out of university at the time, wasn't really in a position to even consider what the future might hold as far as jobs or anything like that. So it was obviously not on my radar to try to keep the cottage. I was obviously sad about it, but yeah, so that's my story. I still go up actually to rent in the winter and ski. Not every weekend, but we're up there quite a bit. So it would have been nice to have that family cottage still, but who knows, maybe one day we'll be able to replace it and get it back in the family. So we'll see.
Yeah, it's a funny story. I think you and I had talked about this. I think we literally were on the same street, which is like insane. But yeah,
Yeah.
and we're the two without the cottages. So anyways, maybe something
Yeah.
about that street. But yeah. All right. So I'm gonna get you into the capital gains. So one is you're just gonna walk through the proposed rules, and then we're gonna break it down from a number standpoint as well.
Yeah, for sure. So the biggest thing I'll try to mention is that these new rules are supposed to take effect for any dispositions happening after the 25th of June. This was announced in the federal budget. Usually when the federal budget comes out, there's draft legislation that accompanies it, and then that eventually gets passed. For these rules, there was no draft legislation. It's still not released, actually. So we're doing a lot of what people are referring to as planning in the dark right now, because although the rules can be simplistic, they often devil's in the detail kind of thing. They definitely get complicated. So that's probably our biggest challenge right now, is that we're getting a lot of questions and unfortunately not knowing how to answer them. The last time there was a change to the capital gain inclusion rate was in the year 2000. There was quite a lot of change from like 88, 89 up to the year 2000, where it sort of went from 75% to 2/3, then back to 50. And but a lot of us, weren't practicing then. And the other thing about it is that there was no sort of standard, across all those years that it kept changing. Not all the rules were consistently changed throughout. So there's a lot of things that we just don't know right now. And the government's promised that they're going to release this legislation sometime before the 21st of June. But that doesn't give us a whole lot of time to iron out any of these details. So that's just one thing to keep in mind. But very high level, what they have said is that they're going to increase the inclusion rate to 2/3. So if people aren't really familiar with what inclusion rate means, it's basically, if you picture, say you have a capital gain of $100, the $100 is not taxable, only $50 is taxable. So with these new rules, what they're basically saying is that 2/3 of it will be taxable. So about $67 would be taxable on that $100 gain. For individuals, we're told that on an annual basis, the first $250,000 of capital gains will only be taxed at the old 50% inclusion rate, and then everything above that would be subject to the 2/3. So that rule doesn't apply for trusts and estates or corporations or anything like that. So basically, if you own, not that many clients that I have that own cottages inside corporations. I do have a few. So they, if they're going to try to get the corp out of the cottage, they won't. Once the new rules are in place, the full gain is going to be subject to the 2/3 inclusion rate. Just a comment about primary residence. I think I saw a question in the chat about it, but the primary residence rules are pretty simplistic when you only own one property. But if you own two properties, so a house and a cottage, it becomes sort of this guessing game in terms of which residence you want to designate as your principal residence. You don't, it's not something that you just do on an annual basis and you're like, file a form with the tax, with the CRA or anything like that. It really, you make the determination when you're actually in a year of sale. And so, picture an example. Let's say, a couple bought their house in 1990, and then in year 2000, so 10 years later, they bought a cottage. Basically, the way it works is that you're allowed to designate any year that you own the property as your principal residence. So if they were, let's just say they were about to sell both properties in, say, the year 2024, they would have available to them, all the years for their house, but only, whatever 24 years for their cottage. So, and then there's formulas that, and a lot of the time what you're trying to look at is which property is going to have the bigger gain. So it's just a bit of a number crunching exercise, but it, the only real requirement if you want to be choosing between the cottage and the house is that at least you live there for, or at least you spend some time at the cottage throughout the year. There's no real, it's not like it says you have to be there for 6 months or anything like that. It's, even just a day that you used at you or any of your immediate children. So that's sort of the proposed rules in a very brief summary. I can go through the just a simple calculation in terms of how this is going to play out. But so the example that we've got is that you bought a cottage for $200,000 however many years ago. In this scenario, and we're just assuming that you're not going to claim this as your principal residence. So if you were to sell this cottage at a price of 1.2 million, if you sell that before June 25th, your taxable capital gain is only going to be at the 50% inclusion rate. So, and I'm just assuming that you've got other sources of income that basically put you into the top tax rate already. So every dollar above your taxable income that's around 246,000 is going to get taxed at this outrageous 53.53% rate. So your taxes payable under the existing rules on this $1 million gain would be close to $270,000. So it's about a 26.77% rate. Under the new rules, what happens now is that you, on the first 250,000 of your gain, of your $1 million gain, half of it's going to be taxable. So that's the 125,000. That's going to be the taxable portion, and then the other remaining portion, the 750,000, is going to be taxed at 2/3, which works out to $500,000 of taxable income. So in total, you've got 625,000 taxable income, and the taxes on that are just under 335,000. So it's about a 33.5% effective rate. Just one thing to note on that is that it's not always going to be the rate because of the first 250 being taxed at the lower inclusion rate. The higher that gain becomes, the higher your effective tax rate is going to be. So unfortunately, if you want to know what the actual rate is, you sort of have to look at the numbers each time to determine. Now, again, just to keep in mind, that's only if it's held individually. If it's held through a trust or an estate or a corporation, as far as we know right now, because we haven't seen the legislation, there will be no the full thing will be taxed at the 2/3, so the rate's even higher.
Right. Okay. Well, thank you, Jim. I mean, that just speaks to there's a lot of numbers going around there, and I mean, this just speaks to making sure you have a professional really quantify the true numbers as to what it'll be. This situation is still kind of, it's in proposal point, so it's not actually in effect. Is that correct? So is it potentially could still do it before end of June? You think they would, or?
Well, there's a lot of talk about, it doesn't seem realistic that they are going to that they're going to be able to implement this. It doesn't, for one thing, it doesn't seem fair to anyone that's trying to do any kind of planning as to whether or not they're supposed to sell, like, not just on cottages, but like securities and real estate sales obviously take a lot longer to actually close. But again, it's all just speculation. People are saying they might defer it to January 2025. But as all we can go on right now, and with the track record of this government, things have with the new draft legislation, not just on this, but in previous, the last couple of years, it's nothing has surprised me. They sort of changed their mind at the last minute. So we just have to wait and see. But that's the reality of what we're dealing with as professionals trying to advise our clients
Right.
on what to do. So,
well, that's fair. And that just, so, I think the point here I take from it is just make sure you keep in touch with your professionals, make sure that you're in the midst of what's going on with this legislation. So you have a true understanding. And yeah, so hopefully you can stick around too, because we might have some questions that'll come out. We're going to try to save questions for later on in this, but I think there may be some other questions, and there's a couple use cases that we were going to talk about that might use your knowledge as well. But thank you.
Thanks, Jim. That was awesome. And what we're really trying to do is sort of, there are challenges with the cottage, and capital gains is certainly one of them. Maintenance cost is another one. We have family dynamics is another one. And what we're really trying to do here is provide solutions tonight to some of these existing problems. So what are the solution? What are the 3 steps that we want to focus on is family first. Who wants it? So we want to have that family discussion. Who wants it? Who's going to be there maintaining it? Really being that champion or that driver for the cottage. Number 2, we need to build out the foundation when it comes to estate planning, when it comes to wills, when possibly trusts. And then finally, the financial piece. We need to be able to finance this cottage for generations to come. And that's where Peter and I are going to still have a discussion about that with everyone. So that being said, Pete, do you want to jump into sort of a family meeting and the breakdown on that?
Yeah, for sure. So we've actually I built out a document. I called it a one-page document. I think it ends up being 2 pages, but really just kind of gives you a bit of a framework to work from. These are pretty important conversations for families. There's definitely, I've kind of laid out kind of some of the basics of it, like in terms of really finding a neutral central place where everybody can meet, have a fixed agenda so that make sure that everybody's taking into account, understanding all the differing needs, differing goals. These are things that have to happen, I think, literally on an annual basis because families change over time too, right? And if you wait 10 years, these things can really, there can be a massive gap in terms of where people are at and what, one sibling wants versus the other. Make sure you're collecting all the necessary documentation of what's involved with the cottage, so you have a good understanding. You can quantify what is needed to keep this in place. Um, you know, talk about, we've talked about this, throughout this is understanding, who's using the cottage, what's the succession plan, who's maintaining it, some of the financial considerations. Dan are going to talk a little bit about that, and then legal and tax implications. So someone like Jim to talk through, what are the scenarios based on what we do and how do taxes get involved in it. And then obviously Emma on the legal side of it to really put together that plan and the solid documentation to put your plan in place. Again, address it on at least an annual basis, I would think. Put that plan to action, involve your professionals, and then document it and review on a regular basis.
All right. Oh, another interactive checkpoint here. Just before we do this, I see some great questions coming in. We really value the question and answer period. We're gonna hold off until sort of the back half of the webinar to do that. If I can ask a favor, if everyone could shift their questions from the chat over to the question and answer section, so we can sort of get a list of question and answer, and then we can deploy those at the end. That would be fantastic. In what year did your family buy or build your family cottage? So I'm excited to see this one. So let's populate the chat on and see 1938. There we go. 1934 and in 2018 looks like some 62, 55. Wow, we have some cottage veterans, that's for sure. 18, 14, 83, 92, 1945. Oh, a rebuild. Very cool, Katie. Yep. 1961, Aylen Lake, 1947. Wow. I would imagine one of the only cottages on Aylen Lake in 1947 being so far north, up almost in Galquin Park there. 1970. Son was 8 days old. Wow.
I just want to add one more thing. I know we're going to save some of this stuff for the Q&A. I see Jim, can you step in there? I saw you responded to someone there. It just relates to the renovations and all that. How that impacts the taxes. Can you just give a quick little
Yeah, for sure. I was typing my answer and then I heard Dan to say we're going to switch Q&A to the Q&A tab. But anyway, I figured I'd answer. So if you're calculating your gain on sale, or even if it's a deemed disposition on death, one of the things that can reduce your taxes is that if you've done any renovations to the cottage over the years, that would add to your cost. So like if you paid, say 20,000 or 50,000 or whatever the purchase price of the cottage was, but you've put in like 200 grand of renovations over time, then your cost isn't just 50, it's 250,000. So obviously that's going to reduce your gain. Obviously you want to have invoices or receipts to support that if you should ever get audited by the CRA. Clients often ask us, well, I paid this contractor cash, like can I include those in my cost? And obviously my answer is yeah, you should be included in your cost, but if you get audited, and what evidence are you going to have to support it? So it's sort of a, you have to just manage that risk with the fact that the CRA could audit, and if you don't have anything to support it, they could obviously deny the amount that you put in for your renovations. And then when you sell, if you actually sell and have paid real estate commissions or legal fees to sell the property, those would obviously be deductible against the proceeds as well. They're called like cost to sell or whatever, and they would reduce the proceeds of disposition, which would inevitably reduce your gain and reduce your taxes. So.
Okay, no, that's good, and maybe it's an obvious answer to this, but you're saving this until you're not claiming it until the actual sale, right? You're not on your annual taxes, it's kind of set aside and saved until you're actually until you've had that transition.
Yeah, and there's a question in the chat here too about saying that not all costs are tax deductible, like foundation repair as an example. So the tricky thing with any kind of cash outlays for a cottage, like, so as an example, like property taxes are just an annual cost. Those wouldn't be added to the cost of your property. If you were renting your cottage out, then you'd be able to potentially deduct annual costs like repairs and maintenance and property taxes and that kind of thing. But when it comes to renos, there's sort of this fine line between what's considered a capital cost and what's considered just a repair. So like, as an example, painting, painting might be just considered repairs, meaning it doesn't fit the definition of what we consider a capital asset or addition to a capital asset. So it's a bit of a, again, a fine line between, what are your advisors going to assist you with in terms of deciding what is capital and what is not. So there's definitely some gray area in that regard. So it's just, again, something you sort of have to manage, that knowing that CRA could challenge you on the fact that they think something is a repair, like an annual cost, as opposed to a true betterment. But
okay, no, that's good. Thank you, Jim. Dan, I think we're wrapped on this question. We got a whole, needless to say, there's a lot of history on this, on this webinar, the amount of, decades and decades of, cottage ownership here. So, yeah, so good to see. And, yeah, we're going to move to the next part, and we're going to have, Emma, and I put it as wills, estates, and trust, but she's really just going to talk about options on the legal side of things, how, you deal with, options to deal with this cottage succession planning. Emma, welcome.
Thank you so much for having me here today. And yeah, we don't know what's going to happen with the land with the capital gains change, but I think it is definitely highlighting some of the things that we should all be thinking about anyways, and that we should know about when it comes to estate planning. So just talking about the cottage, typically the cottage is a secondary property. So there is one thing we need to know is whenever we pass away, if whatever assets that we have, if they're transferring outside of the spousal relationship, then we're triggering capital gains, right? It's a deemed disposition at fair market value when we pass away, or in other instances, whenever we transfer property, even if we're transferring it for no money to our kids, it's still a taxable event. And so I think that's why it's so important, what Jim was saying today, and how it relates to the changes coming up. But there are other taxes that are important to think about. So we want to think about what capital gains are we triggering. And of course, all of the different things are relevant, whether it was transferred to us at a certain time, what was the adjusted cost base, or what was the market value at the time that maybe our parents passed it to us. What are the things that we can expense out of that? Just so we were just talking about that. And what is the value now? That's one tax. It's a major tax. A lot of times people are worried about probate tax, estate administration tax. which I'll talk about in momentarily, and land transfer tax. And land transfer tax is applicable when we are either buying. So if one of the children or somebody is buying the cottage, then that person, if we have an amount that's the sale price, there's going to be land transfer tax applicable. Or if we're going to transfer it to a corporation, which is really not a favorable option, but I can touch upon it just for the sake of touching upon it, then we would pay land transfer tax on the fair market value to the corporation. So those are the main taxes. Probate tax. What is probate tax? Essentially, if we are going to probate, which means that the property falls under the will, it's not under joint ownership with other people with the right of survivorship, and it's left in somebody's name and it hasn't been transferred into a trust, then when we pass away, essentially, the land registry office says, well, nobody's really going to be able to transfer this asset unless you probate it, because we don't want to be responsible for allowing the transfer unlawfully. The act of getting the certificate of appointment of this estate trustee, the executor from the court, is the probate process. And at that point in time, we have to declare the value of the assets of the estate, and we have to pay a tax. And the tax is now 1.5% of anything over $50,000. Okay, and that's the equity value. So if there's a registered mortgage on title, which is not frequent when it comes to mortgages, then we're going to deduct the balance outstanding on the mortgage to determine that. But that can become a very hefty amount. So there are ways to eliminate probate tax. And at the same time, we just have to be really conscious about what are the capital gains that we're going to trigger, because they will become taxable. So when we're talking about cottage transfers, the main things we're thinking about is money. What is the taxable, what is the tax owing when we transfer? And the other thing is group ownership, and what is the best way to harmonize group ownership, and what is the best way to hold group ownership together. And I could probably talk about this for hours, because everybody's family is completely different and their strategies are different across the board. So I can't tackle every single situation, but it's certainly something to talk about. How do we minimize family disputes? And, we got to think about this generationally, right? Because parents might have given it to 2 kids, but now the 2 kids each have, 3 kids and 4 kids. And, if one hands theirs over to the 3 kids and one hands it over to the 4 kids, and we got 7 people on title, how are we managing that group ownership in a way that's harmonious in the future? The other thing to think about is, if we're going to be transferring title to people in their name, how does that open them up to disputes in the future, whether it's creditor disputes, bankruptcies, matrimonial disputes, and whether these parties can have a claim to the cottage, which is something also to think about. And of course, just tax reporting requirements and the ongoing administration. So if we created a corporation, we would have yearly, annual returns to do, and annual resolutions to do. If we created a trust, we would also have that reporting requirement. So let's continue, and let's just hop into a few different options, and I'll try to just kind of explain each on a simple level. So joint ownership. One thing that we know is, when we transfer, if I have a property and I transfer it from myself to maybe me and other people on title as joint tenants, then if I pass away, then my name can just get off title without probate. There is the right of survivorship, and the other people would just become owners. Okay, so that's one way, and it's meant to avoid probate. Okay, so it avoids probate, the process, because really we're just removing someone off title. It removes the estate administration tax, which is the probate tax. It's not generally not possible. Mortgages, when there's a mortgage on a property, the mortgage is a loan and it's pledged by the asset holder. So usually these loan documents say you're not allowed to transfer, because then the asset holder changes. And so it becomes a little bit more nuanced when there's a mortgage on title, which again is not typically the case with cottages, but sometimes it is. So it's just something to think about. When we transfer ownership, there are a couple different ways to tackle this from a tax perspective, because oftentimes we can do a bare trust transfer. So let's say, mom is going to transfer the property to 2 children as joint tenants, but it's not really their property. Okay, it's going to be theirs when she passes, because maybe it's her primary residence and she's claiming it as her primary residence. And so we want to retain that ability to claim it as a primary residence, but we want to avoid probate. So that's what's called, a bare trust arrangement, where a trust a trust is a vehicle where somebody or some people are managing the assets for the benefit of someone else. And this, like a typical, inter vivos trust that we create, where we put a bunch of different things in there, whether it be property and investment accounts and different things, that's kind of a more robust trust that I'll talk about momentarily. A bare trust agreement is really just like an agency agreement, right? It's so no one's claiming the property as theirs. It's still going to be the primary owner's asset. And we're just adding people on title essentially just to get rid of the probate requirement. The CRA did come out with the new trust reporting requirements that caused a flurry, because this is a very common technique for many people. And so they retracted that a few days before the reporting requirement was going to take effect. And now the bare trust arrangements aren't necessarily like the reporting requirements aren't applicable, but it's something to know. Now, in that bare trust, the owner is going to retain kind of the ownership, beneficial ownership, until essentially they pass. Okay, so if it's not a primary residence, then that's something to toggle with, right? Do we want to transfer it as a bare trust agreement, or do we want to actually transfer it and trigger the capital gains and start a new adjusted cost base for the people that we're adding? So in this circumstance, for example, mom could choose to just say, okay, I'm adding kids to title, still my property, I'm going to claim it as my primary residence. Or we could say, well, we're going to transfer it, but we're actually going to give them half the property, okay? And they're going to claim that they've acquired half of the property, which then might be their secondary property, and we might need an appraisal at that time for our records. So that's kind of something to keep in mind. It's done at fair market value to distribute the ownership. So I just kind of explained this a little bit. I hope that made sense, that capital gains is triggered either on the death of the main beneficial owner, or if we choose to actually transfer ownership, whatever that might apply, percentage that we're giving away, it might trigger a capital gain if it's not a primary residence. If we do this, then we're not protecting the asset from potential claims against the people that we're adding on title. Okay, so creditors, there's a bankruptcy, there's a matrimonial dispute. We're not really protecting the cottage in that sense. So something to think about. The other thing is, if we're adding more people on title, how are they going to maintain harmony between them? And so oftentimes we might want to contemplate a co-ownership agreement. What are the terms of how we're going to use the cottage? Who gets to use it? How are we scheduling? What happens if somebody wants out? Does it force sale on the market? Do you have to give the other person the option to buy it first? What periods of time are you going to implement for that sale or transfer to occur? Okay, something to think about. Property maintenance funds. Are we going to have to create a fund? Do we have to think about who's going to fund the repairs, capital improvements, simple maintenance if things break, things like that, insurance? So these are all things to think about in any type of group ownership. So it'll obviously apply here. And then how are the beneficiaries taking title? So in this case, we would want a joint tenancy if we're trying to avoid probate. And then later on, are the kids going to want to have joint tenancy between themselves? Because, if they each have kids, if they are on as joint tenants and one passes, then, well, their kids just got cut out of the cottage, it goes to the other side. So some nuances to think about with joint ownership. Sometimes it's it all depends on the family dynamic. And I think we had one question, right, where somebody was their primary residence, and maybe that's one of the options. I don't know. It takes some discussion. Let's move on to the next slide. The other option is to just simply sell the cottage, okay, and avoids family disputes. You're going to pay the capital gains, and you're going to avoid probate if you sell it in your lifetime. Doesn't keep the cottage in the family unless you're selling to a family member. So that's an option. One option that I just did with a client is, we're selling it to one of the kids, but the sale, the sale is the price. The sale funds are not due right now. They're going to actually become due on my client's passing, and then we're going to equalize the estate based on what we've determined to be the sale price to that beneficiary. So, there are kind of different techniques we can use with different family members. And if this capital gains change does come into effect, which is kind of iffy about, that might be one of the options. And so that's kind of something that we thought about with one of our clients. And if that is the case, so, in this case, we are going to equalize it in a trust, not a will, but you may choose to sell it to a child and register a mortgage on title, and then the mortgage will ensure that payment goes back to the estate. So there's different techniques, whether we use the will, whether we use a trust, whether we use a mortgage. There are different techniques to sell or to transfer the asset to a family member or somebody we know as an option. And of course, land transfer tax will apply to the person that's buying it. And, the capital gains on that sale price will be applicable. So another option. Let's go to the next one, is to pass the cottage under your will. So your will can dictate the terms of course, everything that you leave behind. Whatever you leave in your will, you're going to get a deemed disposition trigger at fair market value on the date of death. And that's not applicable to spouses, but it is applicable outside the spousal relationship. And then in your will, you can have a variety of different things. I mean, you could give one of the kids or, whoever the right of first refusal. Do you want to buy it first and from the estate? Again, you're not missing probate taxes. Okay, you're not really doing anything with the capital gains ahead of time. You're just kind of thinking about it. So it's still stuck in probate. And you can incorporate different things. Like you can create a co-ownership agreement ahead of time. Like we can create all types of things that you can integrate into your will that say, okay, well, if you want to keep the cottage, then you will have to agree to these terms, right? You can create in your will as well a fund. So, the cottage can either go outright to somebody, you can put it in a trust and create a trust through your will. And you can also create a fund through your will to fund the cottage if that's what you want. But something to think about in terms of the primary residence exemption and why James is really important here is, you want to start thinking ahead of time of what capital gains you're looking at. What can you document now that will reduce that? And, like what is the best plan for that? And of course, in your will, you can provide mechanisms for how you're going to value the property and so on and so forth. So it's not passing the cottage under your will is definitely an option. And I don't know if it's the most favorable option. I think between joint ownerships and cottage trusts, those are the most popular ones. So let's move on to the next one. So creating a trust. So a trust is basically a flow-through tax entity, okay? And when we create this trust, and we basically create a document and we create this vehicle and we say who's going to be the trustees, who's going to be managing the assets that are in the trust, whether it just be a property or its actual accounts. We can put any assets into the trust. We can dictate who's going to be the trustees, one more, however, how are they going to be replaced, and so on and so forth, and who's going to be the beneficiaries. So who are going to benefit under this trust and ultimately take over. When we create a trust, this is more James' wheelhouse, but of course we interplay together. When we create a trust, when we put assets into the trust, usually we trigger that deemed disposition at fair market value. There are a couple of different exceptions, mainly for the purposes of estate planning. So alter ego trusts and joint spousal trusts are for people that are above the age of 65. And when you're above the age of 65, you can transfer assets into these trusts, and they will avoid probate, and they also, you don't have to trigger. So, and this is a discussion that you'll have with someone like James, right? Do you want to trigger a portion of the capital gains? Like it'll be up to you. Like, but if you're over 65, it's up to you whether you want to trigger it or whether you don't, but you're going to put assets into this vehicle. And so you know, when we pass away, our estate is actually a trust because we are not alive and we are the owners. And so we have executors under our will. And if we don't have a will, then those people are appointed by the court to manage whatever we left behind for the benefit of our beneficiaries, whether defined by a will or whether defined by law. If you didn't make a will, the law will have a formula. So a will is actually, an estate is actually a trust. The difference is that when you wait to pass away, the court has to basically formally appoint the trustee. When you have a will, it's very easy. Well, it's easier when you submit the will to court, and the court will officially appoint the trustee, and it'll make it a trust. For the trustee will act for the beneficiaries under the will or under the law. When we create a trust in our lifetime, which is called an inter vivos trust, we are basically taking that probate process and we're putting it ahead of time. We're doing it ahead of time, right? And so I often tell people, because there is a cost to making a trust in your lifetime. You're going to have that cost anyways if you probate. Okay, it's almost the same process. It could even be more complicated depending. So if you just take that process and you shift it to before probate, then you're avoiding the probate tax, the estate administration tax, which could be in the thousands. There's an estate administration tax calculator that the ministry has. We can always check it. And you're also avoiding the timeline, because often probate takes time and we can't even, like, if we want to sell the cottage, transfer the cottage, mortgage the cottage, or whatever asset it might be, it's frozen in time until we actually get that approval from the court, typically. So that's something to understand about trusts. Okay, so we could transfer the cottage into the trust and we could trigger the capital gains at that point if we're under 65. It's an option. Okay, once things are in the trust, one thing we have to know, that $250,000 leeway, right, doesn't apply for things that are in trust or in corporations. So that's a capital gains thing to consider. Once things are in the trust, there's a 21-year period. And after that, every 21 years, the CRA is going to look at it as, oh, the trust sold the property and reacquired it at fair market value. So you're triggering a capital gains at that point. And this primary residence exemption can't be toggled as between, you know, your house or secondary property. So you lose those abilities. But what are some of the other things? You know, you still maintain control, like you're putting things into the trust. You're probably the trustee. You other people, we could always decide on that. And you're making all the decisions. You're just basically avoiding probate. There are different things we can do in trusts, like a sprinkling inheritance trust basically leaves the terms of the trust open for, you know, after it's created, for who's going to inherit it later. And there's, you know, at that 21-year period where we can decide, and maybe we don't know who's going to have it now, but we can just have terms of the trust that will basically act as a will. Okay, but a trust is essentially the same thing what a will does, but like I said, ahead of probate, and in your lifetime you can decide a lot of these things. There are yearly reporting requirements for the trust. So again, just like how you would do your own tax return, accountants have to do a T3 return. And trust, essentially, if they do make money, if the assets are making money and that income is not distributed in the year out of the trust, then it's going to be taxed at the highest rate. So a lot of interplay with your accountant that has to be done on a regular basis when you have a cottage trust. But what are you also doing? You're protecting the cottage in the future from disputes from bankruptcies, creditors, matrimonial disputes, and you're avoiding probate. And of course, you can set up all the rules that you want with respect to the distribution later. There is this underused housing tax that needs to just get, you know, it's just a reminder, again, more reporting requirements that you just have to be conscious about, that you just have to make sure that you're filing. So that's another popular one, creating trusts for anybody over 65. There's a lot of benefits that come to putting assets into a trust. And of course, even if you're under 65 or if you're over 65, if you want to trigger some capital gains, that's obviously a discussion that you can have with accountants, but there are many options. I think the last one that I said is a corporation. So it's not really a desirable one. What would you do? You would transfer the cottage into a corporation. Well, on a very, I mean, you could do it in a way that you say, okay, well, I just want to avoid probate. And you could transfer a cottage into a corporation as a bare trust agreement, right? So you're not really putting it into someone's name as their ownership. You're just putting the corporation on it. The corporation could say that it's holding it on the basis of this bare trust. And you would have two wills. And for anybody that has corporate assets, you definitely should have two wills, because the second will is for non-probate assets. So assets that don't require probate. And a corporate book is a private thing between your lawyer and your accountant. We change ownership. So, you know, one thing is putting the property and title of a corporation as a bare trust. It's an option. If you actually want the corporation to own it, you're going to trigger land transfer tax. You're going to lose that $250,000 allowance subject to 50% for the capital gains if the law passes. But, you know, you could definitely distribute shares among family members. You could do that in a secondary will, say how you're going to distribute the shares. You could create a shareholder agreement ahead of time that basically dictates, you know, what's going to happen with the owners, which are the shareholders. What if somebody wants out? How does that operate? And you can have the control to do that within the shareholders agreement. And, you know, as a corporation, you can enact rules, just like condos enact rules under their corporations. You can enact rules for the condo. But, you know, again, you're losing that primary residence exemption. You're not going to avoid that capital gains tax in the future. Okay, so whatever we're kind of thinking about in terms of this additional corporate capital gains might be an issue. And of course, you'll have your yearly reporting requirements to, you know, file the tax return for the corporation. So those are your general options when it comes to transferring the cottage. And, you know, and sometimes we use a combination of different things. And sometimes we use a combination of the will, joint ownership, trusts, and everybody's a little different. But at least that kind of gives you a brief kind of summary of the legal tools available to you to transfer the cottage.
That's great. Thank you. Thank you, Emma, for that. I do have a question. I know we're gonna save most of it to the Q&A. I do want to ask you one as well. How does this play into people who maybe have like cross-border situations? How does that work?
Yeah, I from an estate planning perspective, like and James, you can talk about this on a tax level, but from from estate planning perspective, I always say, you know, you should have a different estate plan in every jurisdiction, because every jurisdiction has different succession laws and different tools available. Like Florida has things that we don't have, right? Florida, you can add people as joint owners, but not really. They don't really have the same rights, but you avoid probate. Florida has a lot different rules when it comes to trusts and things like that. Still, the deemed disposition of all your assets is still going to happen at death, whether you're inside the country or outside the country. So if it's an asset that's in another jurisdiction, the asset is in another jurisdiction, have another succession plan for that, and know what your tax trigger is going to be on death.
Okay. No, that's good. Well, hopefully you can stick around for the Q&A, and we'll expand on a couple of these use cases as well. So thank you again for really just, again, this comes down to make sure you're talking to your professional like Jim, like Emma, because there's a lot of options that are available, but it's really getting a really true understanding of what your objectives are to really for them to be able to give a professional opinion is so important. So yeah, thank you.
Yeah, thank you, Emma. What a wealth of knowledge. So good that there's so many options out there, and Emma's fantastic with bringing to light all the different options. So thank you once again. All right, checkpoint questions for you guys. How many generations has your cottage been in the family? So if we could populate the chat with that right now, and it's almost like a seventh inning stretch, Pete, at the baseball game we're doing right here. So
Five, that is
five
crazy.
generations, Dave. Wow. Wow. 3 generations. 4, 3. Yeah, it's so cool to think about how, how many people have come through a cottage experience, friends, families, loved ones, I often wonder at my cottage, you know, the web of people have come through. You know, it's probably over 5 generations. You know, in the thousands of. It's pretty cool, like the guests that you have up and the reach that you have. Um, yeah, this is really neat to see. Very cool. All right, Pete. I think let's keep this ship moving at sea here. All right. Financing the cottage. This is another monster, as well as the tax implications and the state and what Emma was talking about. The cottages they are expensive and they need money. And Peter and I are going to talk about some options that we feel are very, very important when it comes to financing capital gains and ongoing costs. So let's dive in, Peter. All right. So the reality is cottages are very, very expensive. We have some statistics and data that just came out from Remax in Q1 of 2024 here. Average Muskoka cottage, 1.4 million. Average Haliburton cottage, 968,000 on the sale price. And the average Kawartha cottage price, almost $900,000. And I apologize, I can't get everyone's area in here, but what we're seeing on this statistics is cottages are becoming very, very, very expensive. The landscape has changed over the last 15 years. I don't think it's going down, only probably up, and we are going to need to implement some tools in order to navigate sort of the murky waters that are ahead when it comes to financing the cottage. So how do I pay for the cottage? So we like to look at things as tools. So we have savings accounts. You know, we might have a cottage saving account where we're putting money into, so a traditional bank savings account where we need to draw money to pay for the cottage. It might be selling some stocks that we've accumulated over time. You know, it might be selling some real estate that we've accumulated over time to pay for the cottage, whether that's a primary residence that you want to sell and moving to the cottage, or whether that's a rental property that we need to sell. You know, something has to give when it comes to paying for these cottage. What Peter and I really want to talk about, sort of it's an enhancement to what you're already doing and the tools that you already have in your toolbox, is a financial multi-tool that we want to talk about. And that's cash value life insurance. And we also like to view it as sort of the family cottage bank. And we're going to show you demonstrations on how we've personally built out sort of a cottage bank using cash value life insurance. So if you see this picture here, top right, you'll see me standing up here with my my two sons. It's really what I'm trying to, a metaphor for is generation to generation. If we look at the bottom left-hand corner, it says cottage owner and cash value life insurance, and there's an estate benefit. In 2019, I implemented my own cottage succession plan by putting a whole life insurance or a cash value life insurance on myself and my wife. And what we were planning on with that is, you know, when we pass along at the ripe old age of old, you know, there is going to be an estate benefit or a death benefit that is going to come to my children. And that large sum of money is going to be there to help extinguish capital gains on the cottage, to help extinguish maintenance costs on the cottage. I can really rest assured with the plan that I put in place that the cottage is going to be well taken care of for generations to come. Now, it's important that it just doesn't stop at my generation. It goes on to the next generation. So in 2019, in implementing my plan, I also put life insurance policies on my 3 children as well. And the design there was when they are old and they pass along, a large sum of money will come down the pipe in a windfall, tax-free, for their kids, and so on and so forth. So in the years to come, I will be putting life insurance policies on my grandkids to ensure this generation to generational plan will stay in place and continue to move forward. So that kind of just gives you sort of the an overall picture of an example of a cottager and what I have done. So Pete, if you could just flip over to the next one, we'll kind of dive into why is cash value life insurance used for cottage legacy planning anyways? Well, there's some key factors and some key points that are really, really valuable. So it is a permanent life insurance contract that provides a tax-free, and I talked about that earlier, windfall of money that pays out to family members. Okay, so they will get that money in a lump sum, and the key is tax-free. This money can be used to extinguish taxes, the dreaded capital gains tax, and the other expenses that we talked about. These policies are placed on family members, ideal for all generations to provide a continuous generation to generation windfall, like we talked about in that previous slide. All right, Peter,
Right.
I'm going to
It's
throw it
over to
to you here.
me.
Yeah.
I kind of struggled with this one because there's so many different ways you can go with this. But so I built out 3 generations of options for family members. And actually, I'm missing, for some reason, this picture is not showing just above, just in the top right-hand corner, but it's a book called What Would the Rockefellers Do? And the reason I bring that up, in the book, it talks about 2 uber wealthy families in the US. I mean, really globally, they've created massive generational wealth. The Rockefellers are 6+ generations into it, done really well in business, but built really good succession plan with life insurance, but also tying in family trusts, the right estate plan to ensure the succession will continue on. And now I take it to the comparison is the Vanderbilts. The Vanderbilts are interesting too. Famous name as well that you hear. They over 100 years ago had more money than the U.S. Treasury had, over $200 million. And within 2 generations, they spent it all. They were socialites. They just didn't have a proper plan in place to build it out. By the 1970s, they didn't have 1 millionaire in their family. Anderson Cooper, ironically, is a Vanderbilt. However, he didn't build his wealth through this family wealth. It was self-built. But you see, without, it's the same as winning, winning the lottery. Without, the life insurance itself can be a great payout, but without a plan to tie around it, it can all fall apart. So the idea of really here, why we're here today, is really to help people build out plans to make sure that we can create sustainable, in this case, generational wealth, or create that legacy with the cottage. So the first example, I've started with a female age 60, putting in to a cash value life insurance policy for 15 years, $10,000, so $150,000 deployed out. You'll see by the typical age, I know, like if you're 60 by now, there's, the stats say you're going to live well past 85, but the typical age would be 85. That would extinguish a good portion of that capital gains tax. Again, we'd have to work case by case to build out the right plan for you, but you can see over time that builds out, enough to cover off those taxes, and it can be an enhancement to whatever you do. The point is, where we come from is we feel like it's a very underutilized, faceted financial tool. But you'll see I have actually a second column here beside the benefits called cash value. And this cash value becomes actually a privilege of the policy owner, where you can actually access that cash at any point in time. It's your contractual right as an owner of this policy to be able to access it. If you borrow from the insurance company, you can borrow up to 90% of it, or you can take it from cash from them. The other option is to use it and collateralize it with the bank, and the banks will collateralize up to 100% of the cash value. The second one is really that next generation. So in this case, I used a 35-year-old, similar numbers, 15 years, $10,000. You'll see over time the impact of this tool. This tool is working. You're working with something that is tax. It's growing in a tax exempt world. So it's kind of like having a TFSA built in this system. So whether or not you're holding it personally or through a corp, as to some of the other structures that Emma talked about, this grows tax-free till the end of time. And it's through the course of leaving to this contract and compounding over time where you're going to see some massive massive growth that just continues to pay out. So this benefit will more than cover off the estate coverage, but also leave money for the family as well. And then also it will allow you to also put in, you know, some of that cash value we're seeing, like Dan talked about, some of the maintenance costs, the property taxes, all those other things. This can be an access point for you to use when you need to use it like a bank and pay yourself back over time, like you would a bank. The third one, this is like, I find the most powerful one, is like retire your grandchild. I know it sounds a little cheeky when I say that, but imagine being able to retire your grandchild. So over the course of 20 years, put in $10,000 a year. Again, depending on your situation, you tweak this number up or down. But by age 67, they've got over $4 million in cash value sitting in this system, which is like, which I don't think most people could imagine that being possible, but it is. And understanding that as you go through some of these situations through life, the different stages, this can be used for retirement, but also can be used to perhaps a down payment on a house, can be also used if you get married at age 30, schooling, whatever that may be. I have a couple stories I wanted to add to what I was going to talk about here. Is I had one friend, I had breakfast with them a number of months ago, and he was talking about some of the stuff we're doing with family and cottages and all that. And he said, like, we literally would have had to, if we didn't put in the proper plan in place, life insurance and all the proper estate plan in place, we would have to sell our house in order to be able to keep the cottage, because my father-in-law's had this property for X amount of decades. And, really what the goal we're trying to do here is really empower people. The other story I'm going to relate to as well, and this kind of talks to the power of this type of contract, is a story of two business owners, business partners. They started in the construction business decades ago. They both got insurance policies back, 40 plus years ago. And both were very successful, even investing in real estate. The one had done really well. The second one did uber well. He had well into 8 figures of real estate, but in the last couple of years had really just over leveraged and got caught and ended up losing the whole portfolio. What does he have? He has $4 million sitting in cash value inside his life insurance policy, which is creditor protected, judiciary protected. It's going to grow to the end of time. And he's able to use that to help him in retirement. And so we'll take you to the next piece, which is really, putting it all together, right? So it's not just about a contract, a tool. You talked about, like, what in life is tax-free. So I say it's like a tax-free savings account. Like, what elements or what financial tools do we have that are tax-free in life? Like, some examples I think of are TFSA is very obvious. Our primary residence currently is tax-free when we pass. A lottery ticket is tax-free. If you win the lottery, amazing, good on you. And the other one is life insurance. So we talked about some of these other elements and tools that, Emma talked about, the family trust, and at the end of 21 years, you get taxed again. If you have life insurance inside that trust, it still doesn't ever get taxed. So it's an instrument that will continue to grow tax-free to the end of time. Literally, no one has a lease in life. We don't know when that's going to happen, but it will continue to provide a tax-free reservoir for your family. And so when we use it, we're not just thinking about, we think of, the whole, I think the big hot item for everybody right now is this capital gains piece, the estate tax, and dealing with that. I think that's an obvious. So that's where this certainly can help out. But we also talk about other events when running a cottage. We don't know if the roof's going to go. We don't know if whatever is going to happen. If we want to do an upgrade, it becomes a source of capital where you can actually use it, pay yourself back over time, and continue to let that asset grow. I think of it as when you use it. So the cash in it grows like a TFSA. You leverage it like you would a piece of real estate. However, you control the terms of repayment to that. And we're going to have Dan walk through an example of how he's using it in his system. And yeah, Dan, take it away.
I don't see the picture there, Pete, but I guess that's the way it goes. It's the
Oh,
motorboat. Yeah, I can see it on mine. But so what that picture is my 11-year-old son. He got his boater's license last year, which was pretty amazing for an 11-year-old. There's no age requirement on for your boater's license. But we bought him a brand new 9.9 outboard motor for his tin boat, and we did that by accessing the cash value in our life insurance policy. So instead of us taking money out of our savings account, instead of accessing money from a different area, I took it from my own Cottage banking system, and I took a policy loan from the insurance company and bought this motor outright. And what that allowed me to do was I will now make payments back to my own insurance policy when I want and how much I want. So that's the beautiful thing about a policy loan is I get to dictate the terms of the loan. And so that's just one a practical example of what I've used. I know cottages, they're going to need roofs, they're going to need docks, they're going to need bunkies. And, you know, that $10,000 that you could be putting in, and that number can be any number, so that it's not a fixed number. That money is not just sort of trapped in there as a death benefit. It actually can be used to fund anything that you want in life, whether that's roofs for a cottage, whether that's a vehicle, whether that's a boat, whether that's whatever, life in general. You have access to that capital during your lifetime, and also going to get a windfall of money in a death benefit at the end. So that's sort of a practical use for that. Pete, I think we covered it. I really, you know, hopefully the listeners could really grasp the idea, but you know, it's more than just sort of a 10-minute snapshot that we're giving them right now. It's really sort of a deeper conversation where we can look at everyone's particular circumstance and see if it's a fit for them.
Yeah. And so this brings us to kind of, as we kind of walk through a bit of this, I'm going to just go through our process. Our process is really to get a good understanding of what your situation is, to see if we're fit to help you out. So initially, you're able to set up a time with us. That'd be awesome. We can get a good understanding of where you're at, what your goals, objectives are. We build out a plan, not just with ourselves. We'll leverage folks like Jim and Emma to help build out the proper plan that really suits your goals and objectives, so we get the right outcome. We provide a solution, and then if ready, you execute on that plan. But really, the whole goal of this is like, how do we keep this cottage legacy intact? And there's a lot of moving parts, and that's why we are, you know, our approach is to be behind that and to help navigate you through that process. Some of the things that we have upcoming as part of this process, we have like content coming out through just talking about keeping the cottage in the family, different ways of, obviously the financing piece, the different legal pieces. We're going to dive a little bit more into that. So you're going to see some of that come out over the coming months. I've got a guide that we're building. It should be coming up by the end of June. And we're going to do a Q&A, but I know that some people can't stay around for the whole time. So we want to make sure that we do get an opportunity to say thank you to, you know, all the folks that have joined, have shown interest in this, and we get it. We understand kind of where you're at. And if you want to have a deeper dive discussion on it, please set up some time with us. We're going to try to answer as much as we can within the Q&A session. Some things might take a little bit longer, so we might have to take it away, but we appreciate you. And we're going to move this on to the Q&A section. But thank you, Emma. Thank you, Jim. Maybe we can start with a couple of questions here. Actually, I have, before we get started, I do have a couple, and hopefully they're still on the call here. And I've got so many things up here. I'm trying to get caught up with what's going on. But Peter, if you're still on, I wanted to kind of walk through your example, and maybe we can I think I had sent this to Emma and Jim as well. So, you know, net of it is he's got a family cottage that's been in place since 1938. Maybe I'll read it if it's okay. I don't know. I don't know, Peter, give me a thumbs up or whatever, but I'm gonna just read through this. My grandparents built their summer home in 1938. My grandmother always referred to it as God's country. They raised my dad and uncle there throughout the summer. When I was a kid, I spent most of my summers there. What a wonderful, wonderful experience it was. My memories continue to linger. My mom inherited the cottage after my dad and grandfather had passed. She was raising 3 kids on her own, but was steadfast in keeping the cottage. She obviously knew how much we loved the place. When my mom passed, my sister and I inherited the cottage only after her home was sold and we had enough money to pay for the capital gains transaction. My sons and sisters family love the cottage as much as we do. Of course, we want to pass it down, but in this day and age, it's obviously it's very costly. Is there a way that we can avoid burden on our kids? What's the best way to pass ownership of cottage to them without breaking the bank? Maybe I don't know, like I think the big thing here is maybe just quantifying what that actual, when we talk about this, is it, is it that capital gains piece? We have to quantify that, what that looks like, and that would be working with someone like Jim to do that. Emma, I don't know if you have any comments on this. Like it's not, I mean, you may not have enough information to go by, but if you have some kind of ideas in terms of strategy would take in this kind of situation.
Well, I think first we have to understand, so mom passed half to kids. And so now, are you guys owning as tenants in common or joint tenants? Likely it's tenants in common. So you just have to know that if you pass away, then that portion is going to be probated. So you're not avoiding estate administration tax. And you're gonna have a deemed disposition at fair market value, but it's half, right? So what kind of a burden is that for both of you? That's kind of really just a calculation of property's worth 500,000 when you got it, now it's worth $1 million. That's a $500,000 gain, but it's split between the two of you. Does the new capital gains thing even apply? Not really. Yeah, not really. Maybe we're just on the cusp, right? We're actually on the cusp. So, I think it's just really knowing that you will trigger capital gains. So this is actually kind of more a Peter and Dan question actually at the end of the day, because you just have to know you will be triggering capital gains, right?
Yeah.
So what are you going to do in terms of financially to figure that one out? And that's maybe where these life insurance policies come into play. And the other consideration from my perspective is that could be a whole mumbo jumbo. Oftentimes I have this, right, where we have two tenants in common. And then, one side will say, well, I'm going to add my kids onto title right now. Okay. So then it's like, half of it now has mom and 4 kids. We have 5 people. And then if this side does it, at some point, we're going to have a bunch of people on title. Okay. And if a bunch of people are on title, and if one of them's incapacitated, are they holding things in joint tenancy? Or you got a whole load of potential legal problems that really just everybody needs to be lined up with. So either everybody has a will, everybody has powers of attorneys, or we have to create some other co-ownership agreement. So I think in terms of how to finance that tax event, I think you want to really maybe look to Peter and Dan to see what you can do financially.
Yeah, we just have to really look at the financial pieces for sure to see if that's where we can help out. So absolutely, we'd be glad to have a further discussion on that. The second one I want to read out before we get into the Q&A section. Just I know this is something that was emailed to me before, so I want to make sure I have this covered off. I'm residing in the U.S. for tax purposes. My share of an island will go to my son in the U.S. What I'm giving is half an island property given to my sister and me in 1996 as tenants in common, so that my share goes to my son. Both my son and I are also Canadians. Emma, do you have any thoughts on that? Maybe I can include Jim on this too, from a tax perspective.
Yeah. So one is, you should have dual wills, one for your Canadian assets, one for any assets held outside the country. So you're at least dividing the process, because we know as a tenant in common, that interest will be subject to probate. And, so basically non-residents that own property in Canada, the rule is that, and James, you'll expand on this, I guess. The rule is that when we want to dispose of the property, there's this withholding tax requirement. So if we're selling property as a non-resident, the purchaser has an obligation to withhold at least 25, sometimes 50% of the purchase price. Okay, so when son becomes the owner as a non-resident, if he ever wants to sell that, then there's going to be with this withholding tax issue, and then it can only be released after a clearance certificate is obtained. Now, I think the only thing I'm unclear of, James, is if we're just transferring it from one generation to the next and there's no real sale price, where does that leave us with respect to the holdback?
Yeah, so usually what I see in situations like this, because it's, even if it's a gift from father to son, and even though the father in this case is not a resident of Canada, it still would be considered a deemed disposition at fair market value, or a disposition at fair market value, even though it's gifted. And so because the dad is currently a resident of the US for tax purposes, the withholding requirement is going to be there. Now the thing with the withholding requirement that sort of gets people, caught up in it, is that it's not like you're paying additional taxes. There's just a lot of additional reporting that you have to deal with in order to get those withholding taxes back. And so, it's going to cost you professional fees to do it, and that kind of thing. And so, I'm not I wasn't clear in I saw the email too. I wasn't clear if the son was like either a dual resident, or sorry, a dual citizen, or if he was a
Dual citizen, non-resident.
yeah. So it just said my son and I are also Canadian, so I wasn't sure if the son's actually a resident of Canada for tax purposes or not. But one of the things we often see in cross-border situations is that with dual citizens that have to file both in Canada and the US, they could still be resident of Canada for tax purposes. And because they, as a resident of Canada, you're eligible to use your principal residence exemption, but there's no such exemption in the US. So it's just, there's, this is sort of probably more of an offline conversation, because there's a lot to kind of unpack. But the big thing is just sort of managing foreign tax credits, and just really at the end of the day, especially with the US, because we've got a treaty, you're not going to end up, paying more tax than you would have otherwise. It's just a lot of complications with your filing, and that's really where you want to be on top of it, and not sort of, make sure you're up to date with your tax filings, and not miss this, because I have seen that happen before, where then you get into penalties and interest and all that stuff, and that's what you really want to avoid. So it's really just going back to Pete's message, is just talk to your advisors, ahead of time, let them know what's happening, so that you can be sure that you're following all the proper reporting that you need to.
Thanks, Jim. I'm going to follow up probably with another question for you from Pamela here. If your capital gain is 300,000, is that considered income? And would you add that to your year income, say 75,000 that you made? Then would you pay the income tax on 375,000? Therefore, you wouldn't have to actually pay the 300,000. It would be added to your year's income.
Right. So I saw that question written in the chat as well. So I think I get what
Pamela there. Yeah.
So so if the gain is 300, so I think what she's saying is that she's got, so like maybe like a salary or something of 75,000. That's her regular income. If you then have a gain of 300, the full $300,000 gain doesn't get added to your income. It's going to depend on the inclusion rate. So in a situation like that, if we're in the new rules, at least as far as we understand them right now, on that 300, 250 would be taxed at the 50% inclusion rate. So now you're at 125. So I'm just going to calculate your taxable income for you. So you've got 75,000 of employment income. Now you have 125,000 of a taxable capital gain on the first 250. So you're at 200. And then on the additional $50,000 gain, that's going to get taxed at a 2/3 inclusion rate, whatever that works out to. Probably like 30,000, I think of right, 35, something like that. Not quite. And then your tax liability is going to be based on that year, what your total taxable income is. So I think in that situation, we're going to get up to about $235,000 taxable income, and then you calculate your taxes based on that. So, at that point, you're getting up to the highest marginal rate. You're not quite there yet. And so, basically, I would guess that your taxes on the 235 is going to be, like off the top of my head, I'd say roughly like 45% or something like that. But yeah, it's definitely not, it's not that you would pay 300,000 in tax. It's just you calculate your income based on what your gain is, and then your taxes are calculated based on what your taxable income is. And hopefully that answers Pam's question.
Excellent. Thanks, Jim. Peter, do you have another one lined up there?
Yeah, I think we've got maybe there's I don't know, Jim, maybe you can kind of go back to that US piece. So if it's a US citizen, I mean, you do kind of do some cross-border US tax as well, but if it's a US citizen owning something in Ontario, there any kind of things to be aware of, like, I guess, legal and tax implications regarding that?
Sure. Our firm doesn't actually do any US tax compliance, but I just sort of kind of know enough to be dangerous type of thing. So if you have what's called a dual citizen, so if somebody's born in the US, but they actually reside in Canada as their tax residency, so they have a home here and they've got a family here, but they still, because they were born in the US, they would have a requirement to file a US tax return and report their income from all sources. They would also be required to file one in Canada. So the issue that we often sort of encounter in these situations is that if you sell real estate in Canada, or if it's located in Ontario, as a Canadian resident, you're allowed to claim or designate that property as your principal residence, assuming you meet all the other criteria, like you don't have another property and whatnot. But the problem is that you're also reporting a gain on that property on your US tax return. And so, because the US doesn't have a similar rule to what Canada has in terms of a principal residence exemption, you're probably going to owe US taxes, even though you're not going to owe Canadian taxes. So it's just again another consideration to really sit down with an advisor and figure out all the different options that might be available to you. That was mostly what the comment was. But if you have a person that's not a resident of Canada and they're selling, so if you have a non-resident, like a resident of the US, but they just happen to own real estate that's situated in Canada, Canada basically has the first right to tax that. And so you would have to, the purchaser would have to withhold taxes, which is usually much higher than what the non-resident's actual tax liability would be. So they have to then file a Canadian tax return, which they otherwise wouldn't have had to because they don't file a Canadian tax return on an annual basis. They'd have to file a Canadian tax return, calculate what their taxes are actually owing on the sale of that property, and then they would usually in those cases get a refund because taxes have been withheld at source. And the complications you run into is usually just that the CRA department that deals with these, they sort of operate a little bit archaically, like a lot of things are done on paper, and the refunds can take a long time and those kinds of things. So and then if you get into situations where if you leave the filing for too many years, you may not be eligible to get your refund and those kinds of things. So those are sort of the most common things I would say in a cross-border situation when dealing with real estate sales.
Peter, you got one lined up there.
Yeah. So I got Lawrence has
Yep.
asked one. I have a family friend. He's not related to me, but I'm to inherit his cottage with my family. If I was to put on title, would capital gains apply, or what is the best route to take? Jim, thoughts on this? I think there will be something, right, in terms of a gain there.
Yeah, sorry, can you?
Family friend is basically
Willing the
willing
cottage.
the family.
Yeah, I think I saw that. Let me just reread it again 1 second.
I'll just, the transfer of the cottage to anyone outside of the spousal relationship is going to trigger capital gains, period.
Yeah.
Right? So I think that's the basic answer. The question is, when do you want to trigger it and how? And I think, do you want to do something, or does the owner of the cottage want to do something to avoid probating that and adding the cottage in the probate process is, I think, the bigger question. So when you say, do you want to add, adding you to title one, does the owner want to add you to title now? There's a sense of loss of control there sometimes. And if they do want to add you to title, are they just going to add you as a bare trust agreement, which is, I'm just on title because I'm going to inherit it after death, but it's not mine. And I'm going to sign something saying, hey, it's not mine, even though I appear on title, and I'm never going to claim it on my tax return. And the real owner on death, that's the tax triggering moment in time. Or does the real owner want to think about adding you to title and triggering some capital gains now? And how much that is going to be a calculation that can be done with the accountant.
Right. So yeah, exactly. Like so when this friend passes away, they're going to have a deemed disposition of all their assets. Now, it's possible that this person that might be the only property that they own, and maybe the only property they've ever owned, so they may actually not pay any tax on it if they can claim it as their principal residence for all years that it was owned. But assuming they can't do that, they're going to have taxes owing. And exactly what Emma said is, like, there really is no way to avoid capital gain from one generation to the next, even if it's a family friend passing on a cottage to a friend. Probate can definitely be avoided if things are done prior to death. But then you get into all these discussions that Emma was just brought up in terms of, do you have capital gains tax that you got to worry about? Absolutely, you're going to have capital gains tax. We used to always sort of say, or my general kind of rule of thumb to people was, try to avoid the probate while you're alive, but don't trigger the capital gains tax until you die, because why would you pay taxes earlier than you need to? Now with the new rules, the way things are going, if somebody is anticipating that they're going to be selling in the near future anyway, or if it's an unfortunate situation where they, their death may be imminent, then potentially they may want to sell prior to the 25th of June, assuming they can make it happen before that, in order to benefit from the lower capital gain inclusion rate. But that's a difficult topic. There's a lot of layers to it, and I would just be very weary of doing anything like that without talking to a professional that can give you the proper advice, because there's a lot of considerations, particularly in the fact that you're going to be triggering tax. It's not like you're getting out of the tax, you're just getting a potentially better rate depending on the numbers.
Really good question here. Our cottage is in my husband's name only. Should we change that to a joint, given I want to keep the cottage? Should I be the surviving spouse? We are 68, and the estimated in capital gains would approximately be $350,000 now. Emma or
Yeah.
James? Yep.
So between spouses, if your cottage is in your husband's name and you're essentially going to inherit it. Yes, definitely. Definitely between spouses, having joint ownership, if that's the plan. I think when it comes to blended families and things like that, it gets a little bit more complicated. But if it's kind of, you're between the spouses, you're each going to inherit each other's assets. And on a very basic level, whatever you're going to inherit, keep between yourselves, go joint, because all that is going to avoid probate, at least on that level. So yeah, I think that adding yourselves to joint, it doesn't create a tax triggering event unless you want it to, right, James? Like sometimes we can toggle with that, and sometimes you want to take that rollover and take advantage of it, and sometimes you don't. And so like all those different nuances that you can do with an accountant. But certainly from a probate perspective, yes, I think that joint ownership is the way to go. And then talking to your accountant or James about about capital gains and how to toggle that is another discussion.
Next one, Joy wrote, do you leave the cottage to the grandkids to avoid a generation of taxes? So instead of, I think the tax is going to be paid no matter what, right? But if you're now, is there a restriction in terms of willing the cottage to the kids, age restriction, anything like that?
Yeah, you got to be majority age. So that's going to be the main thing. You can't really give to minors unless you want to get the government involved and you don't want to do that. So I would say no to minors. But yeah, you're definitely leaving a longer runway. Eventually, still going to be capital gains applicable, depending on how you toggle the primary residence exemption. But yeah, I don't think that you're getting away from capital gains. You're just creating maybe a longer runway, perhaps.
Yeah, for sure. I agree. It's if you so you've got adult grandchildren and you want to gift it to them, you can certainly pass it down. You miss one generation, but the practical and all the other considerations of having an 18-year-old having title to a cottage scares me quite a bit. So I'd be very careful going about that plan, but it certainly might be a good tax planning strategy. Just you want to be mindful of all those other considerations.
Yeah, like you're definitely not protecting against a marital breakdown, bankruptcy, creditors, anything like that. So
Yeah, that's good. Okay, well, I think we got a couple more, but some are a little bit more detailed, so it might require a deeper discussion. So what I would say to that is maybe we can set up feel free to set up some time with Dan and I. We can make those connections as need be. We'll leave the meetup either use a QR code or to this link, and you can set up some time with us and we can make sure we get the right resource to help you navigate some of those questions you may have. But again, we want to thank everybody for coming out today, and we look forward to further engagement. We really know there's a lot of families are very passionate about keeping the cottage in the family, and we want to be part of that journey with you and help you navigate that. So again, thank you to Jim and to Emma for joining us. But from myself and Dan, we're gonna wrap this, and thank you very much.
thank you.
Thanks, everybody.